For decades, Japan was the silent pillar of the global financial system. It didn't make headlines. It didn't provoke crises. It didn't challenge the order. But that has now changed. In recent months, Japan has begun dismantling a monetary framework that supported global markets for more than 30 years. And Wall Street understands exactly what that means. Bond markets are tightening. Yields are rising. And for the first time in a very long time, the US dollar no longer looks untouchable. Today, we're going to explain what Japan is doing, why it terrifies Wall Street, and why this shift could mark the beginning of a much larger global financial crisis than most people realize. Japan, the hidden anchor of the global system. To understand why Wall Street is reacting so nervously, we first have to dismantle a very common misconception. Japan is often viewed as a mature economy, slow growth, an aging population, a country past its prime. That view is dangerously incomplete. Because behind the scenes, Japan has been one of the most important stabilizing forces in the global financial system for more than 3 decades. Japan is not just a large economy, it is the world's largest net creditor nation. For years, Japan accumulated enormous trade surpluses. Those surpluses had to go somewhere, and overwhelmingly, they went into US dollar-denominated assets, especially US Treasury bonds. Today, Japan holds well over $1 trillion in US government debt, making it one of Washington's single most important creditors. But Japan's role goes far beyond raw numbers. Japan didn't behave like a speculative investor. It behaved like a structural buyer. Japanese institutions, pension funds, insurers, banks, bought U.S. treasuries not for quick returns, but for stability, safety, and long-term yield pickup. That behavior created a powerful, often invisible effect. It suppressed U.S. bond yields. It reduced volatility in global markets. It helped anchor the dollar's reserve currency status. In simple terms, Japan made American borrowing cheaper, year after year, crisis after crisis. When the dot-com bubble burst, Japan kept buying. After 2008, Japan kept buying. During COVID, Japan kept buying. Markets came to assume that Japan would always be there, and that assumption became embedded in asset pricing across the entire world. Wall Street didn't just benefit from Japan's presence, it built its models around it. There is another, less discussed aspect of Japan's role. By keeping its own interest rates near zero, Japan effectively exported capital to the rest of the world. This created what economists often call the yen carry trade. Investors could borrow cheaply in yen, convert into dollars, buy higher-yielding U.S. assets. This flow reinforced U.S. asset prices, strengthened the dollar, and kept global liquidity abundant. In effect, Japan subsidized global financial stability, quietly, consistently, and at its own expense. And because this system lasted so long, it came to be seen as permanent. That was the mistake. The end of Japan's monetary exception. Japan's extreme monetary policy was never meant to last forever. It was a response to extraordinary conditions. The collapse of the asset bubble in the 1990s, chronic deflation, weak domestic demand, a rapidly aging population. To prevent economic collapse, the Bank of Japan became the most aggressive central bank in the developed world. It pushed interest rates to zero, and then below zero. It bought government bonds in unlimited quantities. It directly intervened to control long-term yields. At one point, the Bank of Japan owned more than half of the entire Japanese government bond market. This wasn't normal monetary policy. It was financial life support. For years, it appeared to work, or at least to prevent disaster. But it came with severe side effects. A distorted bond market, a weakened yen, reduced profitability for banks and insurers, growing stress inside Japan's financial system. Eventually, something had to give. The turning point was inflation. For the first time in decades, Japan experienced persistent price increases. At the same time, the yen began to collapse against the dollar. Import costs surged household purchasing power eroded. Suddenly, Japan's ultra-loose policy was no longer protective. It was destabilizing. Maintaining zero rates now meant currency weakness, imported inflation, capital flight. The Bank of Japan faced a brutal choice: either continue defending markets and sacrifice the currency, or begin normalizing policy and accept financial disruption. Japan chose normalization. That decision is historic, because once Japan steps away from extreme monetary accommodation, the global system loses its most reliable source of cheap capital. Japan isn't just adjusting rates. It is withdrawing a structural distortion that markets have depended on for decades. As rates rise in Japan, domestic bonds become attractive again. Capital no longer needs to flow abroad. Japanese investors start reevaluating foreign exposure. This isn't a sudden crash, it's a slow, grinding reallocation of capital. And those are often the most dangerous transitions, because markets don't panic all at once. They adjust, they tighten, they strain, and then something breaks. Wall Street understands this, because Japan's monetary policy wasn't just a domestic choice. It was one of the load-bearing pillars of the global financial system. And that pillar is now being removed, carefully, deliberately, but unmistakably. Part 3. The global domino effect begins. When Japan changes policy, the effects do not stay in Japan. They never have. Because Japan is not just a borrower or a trader. It is one of the largest pools of capital in the world. For decades, that capital flowed outward. Japanese pension funds, insurance companies, and banks sent trillions of dollars abroad in search of yield. Not because they wanted to take risk, but because they had no choice. With domestic interest rates pinned near zero, investing at home guaranteed losses in real terms. So Japanese capital became a permanent feature of global markets. It flowed into U.S. Treasury bonds, corporate debt, European sovereign bonds, emerging market assets. This outward flow acted as a stabilizer. It absorbed debt. It reduced volatility. It smoothed over imbalances that would otherwise have caused stress. But that flow was never guaranteed. It was conditional. And now the condition has changed. As Japanese interest rates rise, the logic that drove capital abroad begins to reverse. For the first time in a generation, Japanese institutions can earn positive real returns at home, without currency risk, without geopolitical risk, and without relying on foreign governments. That changes everything. Capital doesn't need to rush back all at once to cause damage. Even a gradual reduction in foreign exposure has consequences. U.S. Treasuries feel it first. Less demand means lower bond prices, higher yields, rising borrowing costs. And unlike in the past, there is no obvious replacement buyer waiting in the wings. The Federal Reserve is shrinking its balance sheet. China is reducing exposure. Europe is constrained. Japan stepping back leaves a vacuum. The United States is uniquely vulnerable to this shift, not because of weak growth, but because of scale. Washington must refinance trillions of dollars in debt every year. That refinancing only works smoothly when global demand for treasuries is deep, constant, and price-insensitive. Japan was exactly that kind of buyer. Without Japan, yields rise faster, auctions become less predictable, market confidence weakens. Every additional basis point matters, because higher yields don't just affect government debt. They ripple outward. Mortgage rates rise, equity valuations compress, corporate borrowing becomes more expensive. This is how a bond market adjustment becomes a full-spectrum financial tightening. The most dangerous aspect of Japan's shift is its pace. This is not a sudden crisis. It's a slow withdrawal. Markets tend to underestimate slow-moving structural changes. They adapt until they can't. And when liquidity quietly disappears, stress builds beneath the surface. By the time volatility shows up in headlines, the damage is already done. Part 4. The yen, the dollar, and a fracturing system. Currencies are where financial pressure eventually becomes visible. For years, the the yen absorbed enormous strain. Japan's ultra-loose policy weakened the currency, sometimes dramatically. That weakness was tolerated, even encouraged, because it supported exports and financial stability. But there is a limit. A collapsing currency is not neutral. It raises import prices. It erodes household wealth, and it undermines confidence. At a certain point, currency weakness becomes politically and economically unacceptable. Japan is now approaching that point. If Japan decides to stabilize or strengthen the yen, it must do one of three things: raise interest rates further, reduce domestic liquidity, intervene directly in foreign exchange markets. All three options tighten global financial conditions. An intervention has a particularly dangerous side effect. To buy yen, Japan must sell foreign assets, primarily US dollar-denominated assets. That means treasuries. Even limited sales send powerful signals to markets. They say, Japan is prioritizing currency stability. Foreign assets are no longer sacred. Liquidity is being withdrawn. Markets respond quickly to those signals. The US dollar remains dominant, but dominance is not invulnerability. The dollar relies on deep capital markets, predictable buyers, confidence in long-term stability. Japan supported all three. A Japan that no longer absorbs US debt automatically weakens that foundation. This doesn't mean the dollar collapses overnight. It means volatility increases. It means funding becomes more expensive. It means leverage becomes more dangerous. The system becomes less forgiving. For decades, Japan functioned as a shock absorber. It absorbed excess supply of debt, excess global liquidity, excess risk. Now, it is stepping away from that role, not aggressively, not dramatically, but permanently. And that is what makes this moment so dangerous, because systems built on invisible support tend to fail when that support is removed, quietly at first, then all at once. Why Japan poses a deeper risk than China. In most discussions about global financial risk, China dominates the conversation. Its size, its politics, its tensions with the United States. But from a market perspective, Japan is the more dangerous actor, not because it is hostile, but because it is structural. China's actions in financial markets are often interpreted through a geopolitical lens. They are strategic, they are deliberate, and, to some degree, they are anticipated. Japan is different. Japan is not acting with political intent. It is responding to internal financial necessity. And markets are far more vulnerable to necessity than to strategy. China can choose. Japan cannot. China holds US treasuries as part of a geopolitical toolkit. When China sells, it is noticed, it is debated. It is often offset by policy responses. Japan's holdings serve a different function. They are embedded in pension systems, insurance liabilities, long-term balance sheets. When Japan adjusts, it does so quietly, through allocation decisions, not headlines. There are no announcements, no threats, no press conferences. Capital simply stops flowing. And that absence is far more destabilizing than an overt sell-off. Markets operate on assumptions. One of the most dangerous assumptions of the past 30 years was this: there will always be someone to buy US debt. Japan helped make that assumption feel safe. But that safety was conditional on zero rates currency weakness, suppressed domestic returns. Once those conditions disappear, so does the buyer. And when a structural buyer exits, even gradually, the market must reprice risk from the ground up. There is no easy replacement. Domestic US buyers are already stretched. The Federal Reserve is tightening. Foreign demand is fragmented. Japan stepping back reveals a market far more fragile than most believed. Investors tend to focus on intentional disruption. They prepare for conflict. They hedge against sanctions. They price in political shocks. They are far less prepared for structural withdrawal. Japan isn't destabilizing markets. It's simply no longer stabilizing them. And that distinction is critical, because systems built on constant support rarely survive the removal of that support without stress. What breaks first? The most important question now is not if pressure will build, but where it will surface first. History suggests it won't begin with equities. It will begin in places that depend most on cheap, abundant, and predictable financing. Sovereign debt markets are the first point of failure. U.S. Treasuries sit at the center of the global system. If demand weakens, yields rise, volatility increases, confidence erodes. This doesn't require panic. It only requires uncertainty. And uncertainty is enough to disrupt auctions, pricing models, and risk assumptions across the financial system. Higher long-term yields don't stay contained. They spill into mortgage rates, commercial real estate, corporate refinancing. Sectors built on leverage feel the impact first. And unlike past cycles, there is less room for policy intervention. Governments are already heavily indebted. Central banks are already constrained by inflation. The margin for error is shrinking. Stock markets tend to be the last to respond. They remain elevated until financing conditions tighten enough to matter. Then valuations compress, not because companies suddenly fail, but because the price of money changes. This is how slow financial shifts turn into abrupt market moves. In previous crises, stabilization came from somewhere. Central banks, foreign buyers, emergency liquidity. Today, those backstops are weaker, and Japan, once the most reliable of them, is stepping away. Not in anger, not in defiance, but because it no longer can afford to play that role. We are still in the adjustment phase. Markets are calm, for now. But calm should not be confused with stability. This is what structural stress looks like before it becomes visible. By the time the headlines turn urgent, the underlying shift will already be complete.